And why is this kind of more convenient to remember than the thing above? Yeah?
Is it compound interest formula?
Again?
Compound interest formula?
Don't get what you mean?
I mean, it's similar to the compound interest formula.
Yeah, but it's yeah. You're right, and we will. So the answer was it's compound interest. Looks like compound interest. Yeah. However, we are not adding something, right? So for interest, you would have a plus in the brackets to the power. Here we deduct it, but and in the end, well, for the interest formula you are referring to, the R would be larger than the C, so it's something that is added up. But in general, the idea is the same. And I mean, can you apply your knowledge about this compound interest on this? I mean, when it's interest, you kind of earn interest on interest, and that's why it gets more and more, right? And here, it's kind of reversed. You deduct something, and then, I mean, we talked about this, then you deduct less and less and less, but from the math, yeah, well, it kind of basically follows the same structure. But can you just read me in words what's standing there?
Well, the one is like 100% of the money, then minus the percentage, and this to the power of the number of years. So like.
Yeah, so the residual value is actually the costs, time, and then, well, what is kind of left after one round of depreciation to the power of, well, the useful years. And I think this is something everybody should be able to guess, whereas I would not expect anyone to learn the formula above by heart. So if you look at this thing, just let me fetch a pen. So here we know P already. So P is, what's P in this example? What's P? Yeah, but what's the number?
0.51.
What?
0.51.
That's bad rounding.
0.6.
Let's say 0.6, right? So that's P. Yeah? That means 1 minus P, that's what? 0.4, right. What do we have here, cost of the machine in our variable form? What's our variable for the cost of machine?
78,000.
Not the number, the variable. How did we call this in the formula?
C.
It's C, right? So we have C here. And then we deduct this 60%. So if you want to have a formula for this 31,250, what would it be? Exactly. That's 1 minus P times C. And then you again only take 40% of that. What's the formula then? Same, exact. It's 1 minus P times basically this what we had before, right? Yeah? So it's 1 minus P to the power of 2 times C, right? It's not the same, but you have to take it to the power of 2. And well, consequently, what we have here is then 1 minus p to the power of 3 times c, and here we are, 1 minus p to the power of 4 times c, whereas this is our residual value, right? So it makes perfect sense, and I think this is something everybody should guess. And then you do a little math and get the p out of this whole thing. Yeah? So you divide the whole thing by c, then you take the nth root, yeah, and then you just shift the p on one side and the rest on another, and what you come up with is this 1 minus this nth root of something. Yeah? So as I said, this is nothing you should learn by heart, but you should get an understanding of how to get to this number, right? Okay. Questions about this? Okay. Then we can go on. So this is then just how this graph looks like. So you see you have this first big depreciation in the beginning, and then it gets smaller and smaller until, well, also after 4 years, if you apply this formula correctly, you end up with the residual value, your carrying amount on the balance sheet. Yeah? Okay. Maybe follow-up question that is not on this slide. What happens if after the useful life this machine is sold for 2,000? What happens in the income statement? What happens on the balance sheet? Last transaction, firm is this machine was used for the 4 years. Now it will not be used any longer, and then this machine is sold for 2,000. You really get this residual value. What happens? Income statement.
You minus 78,000, like how much you bought it for, and plus 2,000.
No, I'm just talking about really year 4. What happens in income statement year 4 when this machine is sold? Just this transaction. Machine is sold for 2,000 after 4 years of use.
So you get 2,000 cash and then subtract the...
Is getting 2,000 in cash something that shows up on the income statement? You shake your head? No, why not? What's going on here? Yes, it's just an asset shift. So you give up this asset with a carrying amount of 2,000, but you get 2,000 cash, right? Cash goes up by 2,000, but your equipment goes down by 2,000. So this perfectly cancels out, nothing happens, not even the total sums change, and it is not some form of revenue that is generated, it's just an asset swap, right? So no effect on the income statement selling this thing for 2,000 after these years. Yeah? Whereas balance sheet is affected, however, not the total sums, it's just an asset swap. What would happen if, well, you were too optimistic and only get 1,000 for this whole thing? What would happen then? So my first question was, what happens if you get this 2,000 you calculated with? Follow-up question is, what happens if you only get 1,000 when you sell it? But you did the depreciation as we calculated and ended up with a carrying value of 2,000. So, sorry? Loss. Exactly, I heard the word loss. So this then has an effect on the income statement. Yeah? If you think about the balance sheet, well, what happens? You get 1,000 cash, but you have this decrease in the non-current asset in this machine by 2,000. Yeah, so things also need to change in the lower part, equity liability. Well, it's not a liability. In the end, we have to adjust equity. This is kind of a loss. Yeah? So it also affects the income statement. How would you deal with this in the income statement? Think about the general structure. What's gross profit? How is this defined? First 3 lines of the income statement, are they affected somehow? No, it's not really revenue we're talking about. It's also not cost of sales, so it's not gross profit. Is it an operational expense, which we sum up in the following? Heard something? Yeah? But you don't do this. You don't recalculate depreciation. I mean, what would this mean? I mean, if it's not that material, you would have to change, in our case, 4 years of financial statements, right? To make it right. Not so good. And I mean, there is the possibility to make restatements. So if financial statements were set up in a way that they were clearly wrong, firms have the possibility to do these restatements, but they will not do this because of such Mickey Mouse things here. So in the end, this is an extraordinary expense. Yeah? So you just subtracted it at the very end. Yeah? It's not really an operational expense, it's something extraordinary you didn't expect to do. I mean, of course, if you realize that you overestimate the residual value every year and every time you need to adjust this, then you made a mistake you should learn from. But if this is a one-time thing and you just have bad luck, it's an extraordinary expense. You have to decrease in the income statement, and then everything cancels out again in the balance sheet, right? And if we take the whole thing around, you were lucky and sold it for 3,000. It's basically, well, some extraordinary revenue. It's not general revenue because, well, it's not the core business of the firm to sell old crappy machines, but you had good luck. But it's kind of a profit, it's part of the profit, and then you have this additional profit if you sell it for more. But usually, as I said, if it's smaller things, you do not adjust previous financial statements, yeah? Because that would be too messy. Okay, very good. But of course, in the end, you should be sure or you should be relatively clear on what happens here. Maybe a few general words about this. How and what you can depreciate is highly regulated usually. So if you think about public companies that are listed on stock exchange, there are a lot of rules where this is all defined. So there are definitions of machinery, what's the expected lifetimes of car or furniture. So there are really tables that show you the years of use. And well, it's kind of regulated and settled, so this is not so much of an issue. More of an issue is that firms, if they start to switch the methodology of straight-line depreciation versus such a depreciation pattern. I mean, firms can do this, but they cannot do it every year, switch back and forth, and they have to inform investors about that they did this, usually. Yeah? Okay. Very good. Yeah, this is what I just said. In the end, it's regulated by local GAAP or IFRS, dependent on the types of assets we're talking about. Yeah? But usually it's straight line depreciation. Okay. Then what needs to be distinguished from depreciation is so-called impairment. So when you realize that an asset loses its ability to generate wealth for the firm, you need to impair it. So then you have to deviate from this clear structure that you deduct a certain amount every year, but you have to write it off immediately if you realize this asset is not worth anymore. Yeah? So we had this car example. We calculated initially with 10 years, and then after 5 years there is an accident or something, the car does not work anymore. Of course, you do not go on with this 5-year depreciation, but you kind of have this expense of the whole carrying amount in this one period where this accident happens. Yeah? So that's what we have here. Yeah? What do we have on the next bullet point? Yeah, I mean, that's just a summary of what I just said. Usually you have this guideline, and here are the 3 elements that kind of determine what's coming out. Then, next topic in the textbook is costing of inventories. So, maybe let me first go here before I go to this slide. If you think back to our first example with this, I think Paul was the name, right? With this, yeah, Paul, with this gift paper wrapping business. We did not make any assumptions about this physical flow of inventory. So this guy bought paper, right? And then sold everything, and then he bought the next bunch of paper. However, if you think about real businesses, this might be a little weird if a firm buys inventory, then sells everything, and only then places the next order to replace this inventory with a new one. And the thing is, prices might fluctuate, right? So you see, we made it ourselves very easy in the beginning. However, we will not, now I basically told you everything I wanted to discuss you. I can go back, I think. So we kind of need to make assumptions about the physical flow of inventories when we want to calculate costs of inventories. So far in the exercises it was easy, and basically the costs of inventories were given to you. I mean, if you think about the exercises you have all done, hopefully, there were transactions that, well, some revenues generated, some inventories were sold for 1,000 and they did cost 800, right? So you already had a price on this inventory. And now the question is, where do you get this price from if this inventory was bought at different costs? So back to Paul, there was no problem because he buys on day 1, at this and that cost, sells everything, so the cost of the inventory that goes out is clear. But now, think about, well, Paul buys 200 meters for $10, pound, whatever, and 200 meters for 12, yeah, and then sells 200. What's the cost of the inventory of the paper he sells? Is it 10? Is it 12? Is it something in between? Yeah? And that's why we need to make some assumptions about the physical flow. And in general, there are 3 we can differentiate, whereas, well, in praxis, at least for financial accounting, only 2 are important. First in, first out, last in, first out, and weighted average costs assumption. So what does this mean? Yeah, well, it's actually directly in the name, first in, first out, assumes that the inventory that was bought first will be sold first. So back to my Paul example, if the first bunch of paper did cost 10, then we assume the first sales he makes is from that bunch, and so the costs are 10 per meter or whatever, or for this 200. Whereas if you assume last in, first out, we assume that Paul basically sells what he got the latest. So in our case, then with this example, well, 12 for the 200, right? Is the cost. And average costs, well, here in this example it would be 11. The amounts were the same, 10, 12, take the average, it's 11 euro yourself. A few words about, well, as I said, in financial accounting, we only use first in, first out and weighted average costs, which is determined by the financial standards. However, in managerial accounting, we are free. You know by now that, well, you're not bound to such rules as in financial accounting. It could also be last in, first out. And in the end, what is determinant for how this is dealt with in managerial accounting is indeed the physical flow of these products. And there are, well, ways to store these inventories that kind of lead directly to something like this. For example, if you think about, let's say, grain that is stored in silos, right? You put it in from above and you let it out below. So it's clear what comes first in this whole thing gets out first. So this makes perfectly sense to have first in, first out. Yeah? However, if you think about, well, let's say some boxes of metal parts, screws or something that are just put into some storage room and then you put the new ones in front, nobody will ever go in the bag and take out what's in the bag, right? So their last in, first out makes perfect sense, right? And yeah, well, in general, another example, maybe goods that do not hold for such long as metal parts, food for example. Having last in, first out would just be stupid because half of the inventory would rot, right? So what gets first in gets out first, if it's not durable, right? And well, weighted average costs can also make physical sense. So I had this example with the silos and grains, but think about gasoline, for example. If you have big tanks, you cannot differentiate if you put it all in one. It's just one mess then. And then, of course, some weighted average cost makes sense. Okay, so that's just the background. Then we have an example here where you should just calculate these costs of inventories given these different methods. So what we have here is two purchase dates, 2nd of May, 10th of May, and then you see on 18th of May something is sold, which is, it's an easy example to be honest, because you can get the whole amount of what is sold from only one purchase, so you do not have to mix things. But yeah, maybe we extend it a little bit. I think that's otherwise just a little bit boring. So yeah, let me see what I prepared. I wanted to do this here. Okay, let's start with first in, first out. So, what are the costs of sales? If we apply first in, first out, giving this. So in the end, it's to come up with, well, numbers we need to set up our income statement, right? So we have this selling of 9,000. How do we cost this? What's the cost of sales if we have first in, first out? Pardon? 9,000 times? 9,000 times 10, exactly. That's basically what we have here. So it's 9,000 times 10, so this is 90,000, right? Then, what about the inventories? On the balance sheet, how would they look like after all this transaction took place? So first step was income statement, the costs of the sales, 90,000, which is easy. Yes, total costs of inventories. How they show up if you only consider these three transactions on the balance sheet. After the three transactions.
107,000.
Pardon?
107,000.
How do you calculate?
The remaining 1,000 times 10.
I hear different numbers. What did I hear?
I said 261.
261,000. No, that should not fit.
270.
207?
70,000.
270,000, exactly. And how do you calculate that?
The remaining 1,000 times.
Exactly. It's 1,000 left out of this first bunch, plus the whole 2,000 out of the second, right? So this is then let me see, 0 here. 270,000, right? Okay. So you see, this is cost of sales, this is inventories. What happens if we apply LIFO? Cost of sales, the amount is still 9,000, but 13, I think I heard, times 13. So this is 170,000. So you see, if you apply LIFO, your income would be stated as lower, right? Yeah? And the reason is that here we have an increase in costs. Yeah? We have a price increase. If you then apply LIFO, it will lead to the fact that, you don't see it, well, your income increases. Okay, then inventories. Well, what we have here is we have the whole 10,000 left for 10 plus, and then the difference 11,000 left for 13, and this is, if I calculate it correctly, 243. Yeah. So if you compare this whole thing, you see, well, with first in, first out, if you have this increase in prices, well, your costs of sales are lower than if you apply last in, first out. However, your inventory is higher, right? So, whereas, well, if you turn it around, it's exactly the opposite. And as I said, this is a very, very easy case. Because you can take the whole sales out of one purchase. How to deal with this if, let's say, the amount sold is 12,000? How do you calculate if you apply first in, first out, if it's 12,000? How do you calculate the cost of sales?
10,000 times 10 and then 2,000 times 10.
Exactly. So you add it up, you say I take the whole first purchase plus the rest from the second one, right? And of course, what's left then is only part of the second purchase, right? Yeah. Okay. I think that's that's not rocket science. Are there questions about this? Yeah. But you see that it kind of depends which yeah, which system you apply and how this affects income and how it affects the assets on the balance sheet, right? Okay. Then I told you about we haven't done the average. I mean, average is easy. Average costs, I mean, how do you calculate the average costs? Maybe it's not that easy. How would you calculate them? Is it just the average between 10 and 13? No? Why would this not make sense? Right, you need some weighted average, right? So you weight these prices with the amounts, and that's how it is done. So you basically have 10,000 times 10 plus 20,000 times 13, and then you divide it by the whole sum, this 30,000, and you get 12 per ton. And this is then the costs you apply. Yeah? So costs of sales, 9,000 times 12, and well, the inventory is just the amount that is left by 12 and we're fine. Okay, let me see whether I forgot something. Yeah, I mean, in this example, we also have the selling price, 15, and then of course you can calculate the gross profit. But I mean, we discussed this already. If you know how the cost of sales change, you can directly infer the profit. I mean, that's clear, I guess. Okay. All things we discussed already. So we have these regulations that you usually only use first in, first out, or the average values. International financial reporting standards do not accept last in, first out. However, in managerial accounting it can be used, and you cannot switch between these allowed methods back and forth. So similar to what we discussed before with the different types of depreciation, here you have to stick also to one you also have to stick to one method you apply. Yeah? But of course you can switch, but you can only do it once, and you need to inform the addressees. Okay. Then trade receivables. That's, I think, the last point on this. What could happen with trade receivables? Basically, what might be happen is that you have to write them off if you realize that, well, the one owing you money is not able to pay any longer. Yeah? So this frequently happens, that customers cannot pay. I mean, we discussed about this, that, well, receiving cash immediately is rather uncommon in businesses. Usually you give the goods and you get some trade receivables, but it happens frequently, well, at a higher or lower frequency, depending on the environment you're in, that you do not get back your debt and your money. Yeah. So we somehow need to deal with this risk. And how this is addressed is actually by using experience values. And these are just some values from the textbook, where you see how, well, often this needs to be done to write off such trade receivables. I mean, here in Norway it basically never happens that your customers do not pay, so it's very secure. However, there are countries Greece, Romania, for example, where this happens way more often, and that's why firms located there need to kind of take this into consideration when they set up their financial statements. So when I looked at these numbers, I was actually surprised by Switzerland, because I would have guessed that they are very reliable, but somehow they seem not to be. And in the end, what is done here is, well, it's kind of considered an expense, and thus decreases profit, decreases equity, and in the balance sheet to cancel. So you write it off in the balance sheet, you get rid of, let's say, 1% of the trade receivables and regard this as an expense. And as it happens frequently and is part of the business environment you're in, usually it's considered as an operational expense. It's just part of the game. If you sell your stuff on credit that you do not get back all your money, that's why we don't regard it as something that is really extraordinary and put it in the operational expenses part. Yeah? But when you do the exercises, the respective exercises, there's usually one transaction at the very end where it says, yeah, well, this or that amount of trade receivable is unrecoverable, and then you deal with it like that. You write it off in the balance sheet, and that everything cancels out. You also need to consider it as an expense in the income payment, so the equity goes down by the respective amount. Yeah? Okay, so that's what we have here. Then what's left is a summary. Income statement help uses in the following way: provides information how effective the business has been in generating wealth. Again, that's the main purpose of a firm, of a business, to generate wealth for the owners. And, well, it reveals the profit for the period and provides a measure of the wealth created, and provides information how this profit was derived. So that comes from the structure of the income statement. Again, first part, sales revenue minus cost of sales, gross profit, really the costs that can be directly linked to this respective revenue. Then all all expenses that are necessary to run the whole business, wages, rent, depreciation, whatnot. Yeah? And this then is basically the operational profit, which is of main interest, but then things can happen that this profit is further decreased, or could also be the other way around, that it's increased. Let me think. Yeah, but not because of the business's main work, but this then gives you the profit of the year. But if you want to analyze a firm, the operational profit is actually what's the most important thing for you. Yeah? Last point here, this is something we will not do this year. We will not look at chapter 6. But we do a little bit more on balance sheet and income statement in the next lecture. Okay, that's it for today. Do you have left questions? Do you have questions left? Okay, if not now, then maybe tomorrow.
I'm just happy that I'm going home already.